Understanding price structure based on the Wyckoff method. Welcome to this video where we dive deep into one of the most powerful tools for traders, the Wyckoff method. If you've ever wondered why prices move the way they do, or how to identify market trends early, this is for you. Let's break it down into the four key phases of price structure: distribution, markdown, accumulation, and markup. 1. Distribution phase. Supply overwhelms demand. The distribution phase is where the market is preparing for a reversal from an uptrend to a downtrend. This phase often occurs at the top of a bullish cycle, and it's where smart money or institutional investors begin to offload their positions. During distribution, prices fluctuate within a range. The supply begins to outweigh demand. The highs show signs of weakness, and we often see fake breakouts, also called bull traps. Key takeaway: be cautious during this phase. While the market may look stable or even bullish, this is where cracks begin to form. Look for volume patterns showing selling pressure. 2. Markdown phase. The downtrend begins. Once the distribution phase is complete, the market enters the markdown phase. This is where prices start falling as selling pressure dominates and demand shrinks. Key characteristics: clear break below the distribution range, lower highs and lower lows form, confirming the downtrend. Panic selling can accelerate declines. Key takeaway: during this phase, avoid trying to catch the falling knife. The trend is bearish, and it's better to wait for signs of stability before entering. 3. Accumulation phase. Demand overcomes supply. After the markdown phase, the market enters accumulation, where smart money starts buying again at low prices. This is where institutional investors prepare for the next bull run. During accumulation, prices move sideways in a range. Demand gradually builds up, often with higher lows forming over time. Volume increases during upswings, indicating quiet accumulation. This phase can take time, but it's where opportunities are born. Key takeaway: look for clues like increased buying volume or breakouts above the range. These are signs that the accumulation phase is transitioning into a bull market. 4. Markup phase. The uptrend takes off. Finally, we reach the markup phase, where prices begin to rise, sometimes sharply as demand overwhelms supply. This is the phase where trends become obvious, and retail traders often jump in late. Key characteristics: higher highs and higher lows form, creating a clear uptrend. Breakouts above resistance confirm the bullish movement. Momentum is strong, and price moves quickly. Key takeaway: this is the phase to ride the trend, but always keep an eye out for signs of distribution, as all uptrends eventually come to an end. The Wyckoff method offers a roadmap to understanding how the market moves through these four phases: distribution, markdown, accumulation, and markup. By identifying where the market is within this cycle, you can position yourself to take advantage of opportunities and avoid costly mistakes. Remember, always pair this analysis with volume and price action for confirmation. Be patient. Each phase takes time to develop. If you found this breakdown useful, don't forget to like, comment, and subscribe for more insights. Let me know in the comments which phase you struggle with the most, or if you've used the Wyckoff method in your trading. See you in the next video.